Hey, um, can you hear me okay? Good. Thank you very much. It's an honor to give this presentation, and I also would much prefer to be in New Zealand. Uh, but I do want you to know that I am wearing my All Blacks. So that just proves my connection to New Zealand. So what I was asked to do was to talk at somewhat abstract level about monetary and fiscal interactions. I will do that, but I'm also going to get into some examples of how I think they have shown up in data. So, why talk about policy interactions in the first place? Well, during extreme times like now or the financial crisis, you want to bring all your policy guns to the fight. You know, with monetary policy going down to the effective lower bound, large scale asset purchases, fiscal policy became very active with emergency transfers and spending. And in crises like this, there's a tendency for policymakers to say, okay, we're going to worry about the long run implications later. These kinds of policy interactions that kick in during these crises are ones that can be turned on or off. They're what I call optional. But during normal times, policy interactions don't disappear. And there's basic economic reasoning that requires policies to be consistent. And I'm going to get into what I mean by consistent. Now, usually when you're writing down a formal model, consistency is kind of a long run notion. But in environments where policies can't commit and people are forward looking, then even these long run phenomena can have short run bite. So these kinds of interactions cannot be turned off. They are ubiquitous. And at a very deep level, this is not a popular thing to say around central banks, but monetary and fiscal policy can never be independent. Okay, so once you get some sort of understanding of policy interactions, you get some fresh insights. One example that I'm going to talk about is how inconsistent policies could undermine inflation targeting. And the example that I'm going to use is Europe's inability to reflate. And then, as a counterpoint, I'll talk about how consistent policies can actually help achieve macroeconomic goals. And there I'm going to draw on some history work that I've done about America's recovery from the Great Depression. So I'm going to present some theory and evidence on both of these. Okay, so let's get our thinking straight. What do I mean by consistent policies? So it's going to be a very simple theoretical model. There's a representative household. That household receives goods Y every period. It chooses consumption and two kinds of nominal assets. There's going to be non-interest bearing currency and interest bearing nominal government bonds. And then, like every good household, it has to pay taxes. So they're going to maximize utility subject to this flow budget constraint, which I think is, the notation is pretty apparent. Here, Q, I'm just going to assume that there's one period bonds in this model. And so Q is the price of bonds, so 1 over Q will be you could consider that the monetary policy interest rate. Now, I'm actually going to talk about it in terms of the household's intertemporal budget constraint, because in a lot of ways, I think that is more revealing about what the economic behavior is that I'm interested in. So what we have here on the right-hand side, this is just going to be the present value of after-tax income. This baby here is going to be the household's initial wealth, real wealth. And then they take their income and they take their initial wealth and they use it to buy consumption goods and money balances. Okay, I just repeat that equation because I'm going to refer to it. So let's define the primary surplus somewhat differently than usual. By the way, you can do all of this in a cashless environment, but I thought I'd put money in there just for the heck of it. So let's define surplus as taxes minus government purchases plus seigniorage revenue. If you clear goods markets, then you're going to be able to cancel some stuff out, and you're going to add a G, right? So consumption plus government spending equals income or output. Now, what you end up with is an expression that tells you what the value of this initial wealth is that the household possesses. And that value depends on the expected present value of these primary surpluses. So what this is telling you is that government debt derives its value from expected surpluses. And that value appears as wealth to the individual in the economy. Now, if we use this expression back in the budget constraint for the household, we can get something that looks like a demand for bonds. So this is the demand for nominal bonds. It's homogeneous of degree 1 in the price level, because what they really care about is real bonds. It's going to depend inversely on the price of bonds, and then it's going to depend on positively on the backing of these bonds. So this is the real backing. So those surpluses are the things that give debt value. Now you can go ahead and tack on a conventional money demand function. So I just wrote it as a function of the this one period bond price and consumption. And then what we have is we have two asset demand functions, and they depend on different objects. For shorthand, I'm going to use this EPV of S as the expected present value of surpluses. I'm sorry, I should have had a P times 1 over Q in here. So now we know what consistent policies are. Consistent monetary and fiscal policies deliver a price level, PT, that clears both the bond market and the money market. And for existence of equilibrium, we need to make sure that the real value of government debt doesn't grow too quickly. And for shorthand, I'm just going to use the word stable. So we can now use supply-demand analysis in the markets for government liabilities to try to understand the nature of policy interactions. I should say, as an aside, that I'm being kind of old school here, and I'm acting as though the money supply is the monetary policy instrument. You can do all of this using the interest rate instead. But I just think that for understanding the nature, the fundamental nature of these interactions, it's useful to put monetary and fiscal policy on equal footing and treat them as controlling their own assets or liabilities. So what are consistent policies? Well, you can just plot these demand functions. Like all good demand functions, they're positively sloped. They're positively sloped because I put the price level up here, okay? So what this says is that whether you look at the bond market or the money market, you're going to get some equilibrium P, and that P better also clear the other market. Now, if a shock hits one of these economies, say there's an increase in the supply of bonds, if there's no change in future surpluses, that's going to tend to drive the price level up. Monetary policy is going to have to do something to validate that higher price level. That is what we mean by the policy interactions that cannot be turned off. Those have to be going on all the time, crisis or no crisis. Now, you don't usually see this kind of exposition. Any fresh PhD might scratch their head and say, I don't know, what are they talking about? We don't see any of this stuff in the new Keynesian model. There's no discussion of a demand for bonds. And the reason is simply that we invoke Walras law. So you clear n-1 markets, therefore the nth market has to clear. In the context of this setting, if you clear the goods market and the money market, well, then we know the bond market has to clear. The question is, how? How is it going to clear? Well, the maintained assumption that trivializes fiscal policy is that what happens in the bond market is completely irrelevant because everything is Ricardian. If you cut taxes today, sell more bonds, that shifts the supply of bonds out, as here, and then you just assume that the present value of primary surpluses goes up by exactly enough so that there's no change in the equilibrium price level. That's Ricardian equivalence. What's going on here, and this is the theme that I'm going to really emphasize, is normally, if individuals get a tax cut, they're going to feel wealthier. But the problem is that wealth creates issues in these new Keynesian models for reasons that I'm going to get to. And so what we do is we make this simplifying assumption that, oh, well, don't worry, because future taxes are going to go up by exactly enough to eliminate all those wealth effects. So now, I'm going to turn to talking about monetary policy and how these wealth effects show up. So I'm going to talk about these consistent policies in terms of the wealth effects. So suppose that there's a monetary expansion that raises the price level. Well, bond holdings would lose value. And so if you go back to thinking about the individual's intertemporal budget constraint, this wealth would decline. Well, if expected future surpluses are unchanged, then individuals are going to feel less wealthy. They're going to reduce their demand for goods. And that tends to offset the higher price level that the central bank was trying to engineer. And so if fiscal policy refuses to validate this higher price level by adjusting surpluses in the right way, then monetary policy's desires can be thwarted. Now, fiscal policy can offset monetary policy's negative wealth effects. Remember that a higher price level is going to have a negative wealth effect on the household. It can do that by reducing expected surpluses. So if this present value of surpluses falls exactly enough, then voila, the price level that the central bank wants to achieve actually happens. It becomes the equilibrium. And in this environment then, because future surpluses are falling, that makes bonds less desirable. Individuals substitute out of bonds and into buying goods, which is exactly what the central bank wants. That then is consistent with a higher price level. And this maintained assumption is what shows up in essentially all the canonical new Keynesian exercises. And as far as I know, every central bank that I've ever been exposed to that uses some version of a new Keynesian model builds in this assumption, which is called passive fiscal policy, which completely trivializes fiscal policy. Okay, so we've had these countervailing wealth effects. Monetary policy has one kind of effect, fiscal policy has another kind of effect. And so these things come down to the question, how much does the expected present value of surpluses react to a monetary policy action? So policies can be inconsistent whenever monetary and fiscal policy imply a different equilibrium price level. Now, in the formal theory, this means there's no equilibrium. There's not much we can't really say much more than that, other than, okay, there's no equilibrium, some policy has to adjust. But what we can try to do instead is consider degrees of fiscal validation for the monetary policy action. And what you want to have in the back of your head is that as we as you get a larger shift in the expected present value of surpluses, you get a larger pivot in that bond demand function. Okay, so fiscal backing is what we usually call this. This is the fiscal backing to monetary policy. Fiscal wealth effects can counter monetary wealth effects. So in the case where you have full backing, that's the sort of canonical New Keynesian exercise, then it happens that the fiscal and monetary wealth effects exactly offset. The only thing that ends up mattering is what happens to the real interest rate, and you get the intertemporal substitution effect that we all know and love. But in the case where it's partially backed, then you get a smaller fiscal wealth effect offset, and the negative monetary wealth effects remain. And then at another extreme, you could say there's no backing at all, no fiscal backing at all, and then you get only the negative monetary wealth effects. So what I'm doing here is I'm going to show you some impulse response functions from a completely standard New Keynesian model. The first example is each of these is a monetary ease. So you can see that the nominal rate falls and then it gradually goes back to steady state. In the case where you have full fiscal backing, again, that's the sort of canonical example. You get a big real interest rate decline. You get a lot of kick from the intertemporal substitution. That's why the output gap goes up. And that's also why, through the Phillips curve mechanism, inflation goes up. But if that backing is only partial, well, now you have exactly the same nominal interest rate path, but you get less kick in the real interest rate because now inflation goes up, but only briefly, and then it becomes negative. And that then tempers the real interest rate path, which feeds into a less of a response in the output gap. And then in the extreme case of no backing at all, well, now this monetary ease doesn't even raise inflation. In fact, it lowers it. And even though you're still getting the real interest rate effect, it's not as big, but it's still there. But what's happening in this environment is this negative wealth effect from the lower interest rate is really kicking in and dominating the response of inflation. Now, what's going on behind the scenes? Well, to see that, I just repeat the first two graphs, and now you can see what's happening to the primary surplus and the value of debt. So in the case of full backing, you get a positive surplus, which then turns negative. With less backing, partial backing, now you get a less of a negative response of the surplus. So in other words, this is more like a fiscal, I'm sorry, let me back up for a second. In the case of the full backing, what's happening is monetary ease is followed by fiscal ease. So you see this big negative response of the surplus. When there's only partial backing, you still get some negative response of the surplus, but it's not nearly as big. And then in the case where there's no backing at all, remember this is the case where inflation doesn't go up at all, now all you get is a positive surplus path. You get no response, no negative, no deficits at all. So this is kind of underscoring the critical role in the models that we use at central banks of the assumption about fiscal backing when trying to understand the effects of monetary policy. Now, the example is Europe. Europe has backing problems, just among us, I'll say that. So I'm going to look at the data before COVID because since COVID, as everyone knows, things have been pretty wacky. But before COVID, the ECB and other central banks that are not part of the monetary union were massively expansionary. There were negative policy interest rates. There were even negative long-term nominal bond yields out 10 years, 20 years, large balance sheet expansions. This created negative wealth effects from the monetary side. And despite these big expansions in monetary policy, inflation remains stubbornly below target. Why? Well, a lot of explanations have been offered. I've read a fair number of them, but none that I have seen have considered the question of, has there been insufficient fiscal backing to offset these monetary wealth effects? So the kind of fiscal backing you need, if the central bank eases, what you need is to run deficits. You need fiscal easing to follow monetary easing. So what have we seen instead? Well, here is the euro area. Again, I told you I stopped before COVID. And the target is 2% inflation. So for a long period of time, it was below. Now it's falling again. And what is the European fiscal stance? Well, primary surpluses. So it has not been that monetary ease has been followed by fiscal ease. Monetary ease has been followed by fiscal tightening. That's even more pronounced if you just look at Germany, where Germany, after 1 year of deficits due to the financial crisis, has been running primary surpluses. And this is in the face of declining interest payments on the debt. They have been running primary surpluses. That's exactly the opposite of what the theory says you want to do if you want monetary policy to be effective. And then I pick on Sweden because I used to advise them, and they're in the same boat. You can see that interest rates are negative. And what has happened is that, again, except for a very brief primary deficit, they've been running primary surpluses, again, in the face of declining debt service. Okay, so if you look at new Keynesian models and you feed that degree of monetary ease into them, you would get serious inflation. So the predictions of these new Keynesian models are at odds with data. This has led to a search for the missing inflation, but I can tell you, you're not going to find it in the usual monetary policy box. I think we need to be looking at what the wealth effects are and try to measure those. And those aren't even suggested by the standard new Keynesian models as things that are objects of interest. And so I would encourage central banks to be, if they're facing a puzzle like this, to spend a little time looking at what's going on with fiscal policy and what's happening with wealth effects. Okay, now there is an example of consistent policies that were also quite effective. I'm not saying we have to go back to April of 1933 to find consistent policies, but this is a really nice example. It's almost a laboratory example. So President Roosevelt launched a successful reflation, and there were several key components to his strategy. The first was to get off the gold standard. And so that converted debt that, even though it paid in dollars, was convertible to gold and therefore had to be fully backed by taxes. It converted that kind of debt into genuinely nominal debt. Nominal debt is just backed by dollars. It's not necessarily backed by taxes. Then monetary policy was just sitting at the effective lower bound. And the other components here are, I think, kind of unique to the Roosevelt situation. Roosevelt stated very clear objectives, and that primary objective was to reflate the economy. He was very explicit about wanting the price level to go back up. He then had this clever device, which was a dual budget. He had an emergency budget and an ordinary budget. And what he said was, I'm going to run deficits on the emergency budget until the economy recovers. But I'm going to balance the ordinary budget. Okay, so he's thinking about there being two different kinds of spending. The ordinary stuff is going to be backed by taxes like it always has been. But this emergency stuff is not going to be backed by taxes. And he was explicitly state contingent about this. He said, we're going to do this until the economy recovers. And so the policy was state contingent, but was also explicitly temporary. And then he built a political consensus for these policies, because you got to remember that until this time, government bonds always had to be backed by taxes. If you're on a monetary standard, a metallic standard of some sort, you have to back those bonds by taxes. And so what he was doing was unusual, and he had to convince people that he was really going to do this. And so he talked about how the crisis of the Great Depression was more severe than World War I. He established that there were extremely high stakes of success. So you might know that in 1933, there were other things going on in the world. And he could point to those things and say, hey, if we don't get our economy back on its feet, you can see what might happen. And then he was very good about communicating his objectives and his strategies in order to anchor fiscal expectations. And this, by the way, I wrote a little paper for the RBNZ Bulletin some years ago called Anchoring Fiscal Expectations or something. And this is a theme that I push on a lot and has not gotten a lot of traction. We talk about expectations and anchoring them for monetary policy all the time, but we don't do so much with fiscal policy. Okay, so one way to understand what he did was he set up two different kinds of spending, and those two different kinds of spending are ordinary and emergency, okay? He said, we're going to fully back ordinary spending, so any change in this surplus is going to be offset in present value terms by future surpluses. Then there's no wealth effect. But the emergency is different. We're going to run deficits. We're not going to back these by future taxes. So this is completely unbacked, and it generates positive wealth effects. So if you look at this, what ends up happening is this policy of ordinary just basically allows you to cancel all this SO stuff out. And this equilibrium condition then gets driven completely by emergency spending. And therefore, the price level is going to get driven by emergency spending. And this ends up generating additional demand stimulus because this unbacked emergency spending raises wealth. And here, if you just take, again, a standard new Keynesian model, feed in a serially correlated government spending purchase shock, if it's fully backed by taxes, so there are no wealth effects from it, then this is the response of output, and this is the response of the price level. If you feed exactly the same shock in and it's not backed, you can see that you get a lot more kick. And so this difference between these lines is the wealth effect. It's what you get from having having this part of spending unbacked by future taxes. And it worked. So he ran these big emergency deficits. That's this red line. The black line is ordinary surplus, and you can see that, more or less it was balanced. So he did what he said he was going to do. He ran emergency deficits until he got cold feet, and he balanced the ordinary budget. And what you can see is that these deficits were financed by growth in nominal debt. So the level of nominal bonds more than doubled over this period. And that is what we argue generated this wealth effect and really jump-started the recovery. And so prices did go up. They didn't go back to the levels of the 20s, but they did go up almost as soon as this policy was adopted. And then this is my favorite picture. I would like to show this to every policymaker. Notice what happened. Until leaving the gold standard, under Hoover, they were running deficits and borrowing to finance them. But the debt GNP ratio went up. Why? Because everyone expected those were going to be backed by future surpluses. As soon as you ran deficits that were not backed, boom, the debt GNP ratio stabilized. So there's no necessary conflict between running these unbacked deficits and fiscal stabilization or sustainability. That's the standard line that you hear, and Roosevelt heard it all from all of the bankers in the country and a lot of economists, that he was going to destroy the creditworthiness of the US government. But in fact, debt ended up drawing less of production than it did under the Hoover administration. So I'll end by talking about today. Thankfully, it's not 1933, but we do see some similarities between what Roosevelt was facing and what our economies have been facing since about 2008. We've had two major shocks. We also have these looming issues, infrastructure needs. We're dealing with climate change. All of our populations are aging. Income distribution is getting more and more skewed. There has been rise of the right and authoritarian governments, just like in the 1930s. There is a deeply entrenched resistance to fiscal expansion, again, just like there was in the 1930s. And just as Roosevelt had to do, our political leaders, if they're really going to do something that integrates monetary and fiscal policy, they're going to need political buy-in. And I think that if given the challenges that we now face and are going to be facing in coming decades, we really have to understand how monetary and fiscal policy can operate together. And so we need to embrace the interactions. So that's pretty much all I have to say. Should I stop my sharing?
Right, thank you very much, Eric. So we have about 20 minutes for Q&A. So we'll get our lovely assistants up to run through the audience. Maybe can I ask a quick question, Eric, while we're getting our microphones out there? So does this, I guess, proposition change if there are strong positive wealth effects from easing monetary policy? So if you put, say, a housing market in with significant supply restrictions into a new Keynesian model, would that sort of lessen the importance for fiscal backing to support monetary policy?
There's still the issue of making sure that that you're going to be consistent in the sense that you've got these two price levels in the two markets, right? And so I think that the question of consistency is still going to be there.
So do we have?
I mean, let me just throw out. I think about the price level as telling us how many units of government liabilities it takes to buy a basket of goods. Adding a housing market while it might have wealth effects and could affect demand in various ways, doesn't really change that definition of what P is or how P gets determined. You understand what I'm getting at?
Yep, yep. Thanks. So do we have questions from the audience? Oscar up the front.
Thank you, Oscar Parker, New Zealand Treasury. Really interesting talk. Just a question. So obviously you've been focused on the primary balance. Does the composition of expenditure or taxation matter at all in this framework, or is it just simply the level of the balance?
No, it's really about the balance. I mean, I don't ever want to say that that the distributional aspects of fiscal policy don't matter. It actually gets pretty complicated once you start thinking about environments with a lot of different kinds of agents. The standard methods for eliminating these wealth effects become exponentially more complex once you have heterogeneity. And so I think this is still kind of an open research question, is whether you can even do that canonical new Keynesian exercise once you're in an environment where you've got heterogeneity. So I assume by your question that when you're asking about compositional things, you have in mind an environment where you've got different kinds of households and, you know, paying different kinds of taxes and earning different incomes and so forth, right?
Hello, Philip Vermeulen from Auckland University of Technology. Does the fact that, so the US has one central bank and one government is one country, but Europe, the euro area is one central bank and many countries, and so Greece is, say, comparable with California or New York borrowing in the US. So is the fact that the euro area is multiple countries, does that change your story?
Oh yeah, in major ways. The critical maintained assumption here is that the government that's issuing the bonds also controls the monetary policy. In Europe, to do the kind of thing that Roosevelt did would require a degree of coordination across countries that seems to be pretty much infeasible in the euro area. So conceptually, you could do it. Politically, I don't see how it would ever happen. Is that getting at what you're asking?
Yes, thank you.
Andrew Coleman from the Reserve Bank. Roosevelt also cut the value of the dollar from $20.83 to $35, or changed the value of the dollar. How does the change, is your model sufficiently quantifiable that you can compare the change in the actual price level from 1933 to say 1939 with the amount you might expect given the bond issue and the bonds not to be paid back, with the actual change in the gold value during that time? I'm not sure if I made myself clear. There would be two theories about what happens to the price level. One is just a change from 20 to 35 because of the devaluation of the dollar, and the other one would be a quantifiable amount that depends on the amount of debt that's issued relative to the initial bonds that you're not expecting to be paid back, and it's whether you've done a quantifiable comparison.
Yeah, well, in the paper, we have some VAR evidence that tells us that if you break spending into this emergency and the ordinary components, that the ordinary spending has very little predictive value for GNP and the price level, whereas emergency spending has substantial. That's not addressing your question, because we don't really do that. We don't break out how much of this aggregate P could be due to the revaluation of gold. I do want to add, though, because this is about monetary and fiscal policy, that there were also substantial gold flows, which were not inflows into the United States, which were not sterilized. And so the monetary base grew quite rapidly. And that is exactly what you need if you want to try to keep the interest rate more or less pegged in an environment where the price level and real economic activity are increasing. So the monetary component is critical to making this all hang together. But I don't think that isn't really what you were getting at. So, this is the old, well, let me tell you what I do know.
So any other questions for Eric? Oh, so we have a few online, so maybe I'll put those through first and then we can come over here.
This is a question from Patrick Darcy of Australian Treasury. How does an open economy setting with foreign investors in the government debt affect the conclusions of the model?
What would end up happening is, and this is actually an excellent question, and it's one of the areas that I think we have holes in our theory. But essentially what you can think about breaking the total amount of debt into two bits, domestically held and foreign held. And so the base against which you are going to be adjusting the price level is smaller if you have a lot of foreign holdings. And that's going to actually amplify the effects on the price level of a given change in the expected flow of surpluses.
Hi, Mario De Maio from the New Zealand Treasury. You talked a little bit about the European experience. I wondered if you could talk a little bit about the American experience post-GFC and the use of fiscal policy in that context, and particularly the political economy constraints to running significant fiscal deficits during that period. And the second part of the question was, these are very large, the last two shocks we've had are very large shocks, and is there something about the size of the shocks that matter in one sense, and during an ordinary business cycle, coordination is in some sense less important, but during these large shocks, it becomes much more important. Thank you.
Okay, let me answer the first question first, and then I'll try to remember what the first question was. The second question first, sorry. The size of the shock certainly matters. I guess part of my point was that these interactions that I was talking about are in play whether it's a big shock or a small shock. So as far as the theory is concerned, what matters is what is the marginal source of financing. And so it's all about how do people expect surpluses will react to shocks that hit the economy and perturb the value of debt. So I actually think that in some ways, your second question also connects to your first, which is that I think we spend entirely, and I am very guilty of this, I think we spend entirely too much time talking about fiscal policy without thinking much about what the political economy dynamics are. So if I were to go back to the US situation after the financial crisis, within a week after the passage of the stimulus bill, President Obama was pledging to reduce fiscal deficits by 50% by the end of his first term. Now, at the time, I thought, boy, this is really bad policy. You know, you either are going to stimulate or you're not going to stimulate. If you want to stimulate the economy, you don't turn around and say, but don't worry because we're going to tax you later. And that's kind of the message of the Roosevelt period. You know, I think he understood that your fiscal policy is going to get a lot more kick if you can tell people that you're not going to raise taxes to finance the spending that you're doing today. I'm getting an unstable internet connection message. So am I garbled? Probably am.
Very fine.
Okay. Anyway, so what I think we need to be doing much more is bringing these political economy constraints directly into our models before we start giving policy advice. I think one of the big advantages of studying the history is that what Roosevelt did was within the confines of all the political economy constraints that he faced, and he still managed to do it. Now, he was facing a major crisis, but there was also, and I think this was a critical element, there was also the international dimension and the rise of Germany and Italy and so forth that I think he was very effective at leveraging to convince people that his economic policies should be pursued. So, yeah, I think the political economy stuff is a big deal, and it often makes it so that the policy advice that economists give is not terribly useful. I mean, going back to the euro, I visit the ECB regularly, and they always ask me for advice, and every time I give advice, I'm told, oh no, the Germans won't approve that, or the French won't go for that, or the Italians are against that. And so the political economy constraints are very complicated and, at least as far as I'm concerned, not well understood. And they're certainly not integrated into the policy advice that we end up giving.
And then Ruben.
Thank you. Dennis Rose, I want to just come to the coordination issue between monetary and fiscal policy. The New Zealand framework has monetary policy focused on control of inflation and fiscal policy anchored to a debt target. That seems to me to freeze out the type of option that you're describing President Roosevelt as having followed. It seems to me that the fiscal policy needs to be targeted at something other than just a debt figure.
Well, before I answer that, New Zealand is actually one of the very few countries that did serious fiscal reform before doing inflation targeting. And in principle, if you run a fiscal policy where the primary surplus reacts positively to the real value of debt, that can provide the fiscal backing that monetary policy needs. Having said that, if we think about that as sort of how policy gets run in normal times, I don't think that precludes doing something like what Roosevelt did during crisis periods. I don't think what Roosevelt did is necessarily inconsistent with achieving a debt target.
Hi, Eric. Thank you for the talk. I'm Ruben from the Reserve Bank of New Zealand. From my understanding of the empirical literature, an increase in government spending on consumption or investment has hardly any effect on inflation. Inflation hardly moves after an expansionary fiscal shock. Do you think the classical New Keynesian modeling strategy has to be amended? Because in the standard model, government spending shocks are inflationary. And the reason why we have higher government spending multipliers at the effective lower bound is because of the inflationary response and the effect of the real interest rate that follows that. So do you think the theory has to be amended to accommodate the empirical evidence?
Well, I think what you're calling on here are some of the sort of simpler New Keynesian models, which it's certainly true. Those do have the result that higher government spending raises inflation. But in some models that I've estimated that have kind of a lot more bells and whistles in them and sort of more nuanced policy responses, distorting taxes and so forth and so on, it's not as consistent that a higher government purchases raises inflation. In fact, in some of the work that I've done, you get pretty big multipliers even though there's very little change in the real interest rate. So it's not coming off of the standard ZLB story. Let me just throw something out here that when you start thinking about these monetary and fiscal interactions, whether the interest rate is at 0 or at 14 doesn't really matter. What matters is whether the interest rate reacts to what the fiscal shock generates. So I think that a lot of the literature, especially in the New Keynesian setting, because they only ever think about one kind of monetary fiscal mix, ends up acting as though the ZLB is a big deal. But it's not, in a lot of these equilibria, it's not that you're stuck at the ZLB per se that matters, it's simply that the interest rate isn't changing. So a pegged interest rate, which is basically what was going on during the Great Depression, generates the big fiscal kick just as easily, but it doesn't necessarily do it through the real interest rate channel that you mentioned.
So I think we've got time for 2 more questions. So why don't we go Yifei at the front and then just here in the middle.
Thank you, Eric. This is Yifei Liu from Treasury. I have a question about the effect of fiscal backing. So in the model with fiscal backing, as far as I understand, the mechanism is that bond becomes less attractive. So people take their money out of the bond market and spend money on the goods market. But do you think it's possible that in the real world, instead of raising consumption, people just buy more stocks or even Bitcoins? Thank you.
Well, I mean, what we're really talking about here is the basic consumption savings choice, not the portfolio choice. So it's really a matter of they find it less desirable to save, and so they shift out of savings and into consumption. You're getting at the portfolio choice, but this isn't really driven by that portfolio choice.
Hello, I am Lauren Breen from the Reserve Bank. Eric, I was wondering if you could talk a little bit about perhaps giving an example of a country that has done really well in coordinating their monetary and fiscal policy, and perhaps the advantages, the institutional structural advantages they may have had, and what they may have done well specifically. Thank you.
Whew. Golly. Well, at the risk of being too much of a cheerleader for my own country, I think partly because our fiscal policy is so dysfunctional, in some ways it has been more supportive since the financial crisis of monetary policy than it has been in other countries. You know, we didn't really get that that same bug that the Europeans got to stabilize debt, or not even stabilize. We did stabilize. Obama stabilized debt, but he didn't shrink it. So if you look at US debt, it's like a step function. Whereas if you look at European debt, it's been coming down pretty steadily. So in that rather narrow sense, I don't really want to call it coordination because that suggests a good deal more rationality than I think we should attribute to our policymakers. But I think in that sense, at least, fiscal policy has not been running counter to what monetary policy has been trying to achieve. And the result has been that even though inflation here has been a tad below target, it really has been pretty close to 2%.
Cool. So I think that's all we have time for. So join me in thanking Eric for a very informative and influential